In this video, I'd like to walk through the investments as they're compared to one another based on the videos that we've watched from Dave Ramsey. First thing that I'm going to do is fill in the blanks along with you on this chart, and then we'll go back and talk about which ones that he finds good to use as a long-term investment and which ones you should probably avoid. This first investment is one that returns at a low rate, so it doesn't return very much money for what you invest, and it's tied to what we call open-ended mutual funds. And really the goal of the mutual funds in which these are invested is to maintain principal. That means they're invested in simple investments that won't lose much value, if any. The gains are going to be very small, as indicated with the return being low. These are called money market accounts. Now, with the low return often comes a low risk, so it's a really safe investment, but again, you're not going to get much for your money. Now, many people will use a money market account at a bank because you can write checks from your account. And what that means is that your money is very liquid. You have access to it whenever you need it. And of course, the downside with there being a low rate of return is that it doesn't really earn that much money. Now, single stocks, on the other hand, these are a high risk option. So with investments that have a high risk, we would hope that they have a very large or high return. But really, when you're buying and selling single stocks, most people tend to get just an average rate of return, slightly better than inflation and taxes, and that's at 7%. And if you recall, this works as an investment because you become a part owner in a company, partial owner, we should say. And as the company does well, then you do well. And you will receive dividends. Dividends are paid when the company is profitable. In general, the stock market is a good place to store your money for an investment. And when you invest in just single stocks, it's really easy to track how that one company is doing. The downfall is that this is a high risk, and there is a potential for this one company just to do poorly and ultimately, say, go out of business. The money that you invest in a company that goes out of business is in turn lost. And for that reason, you might want to stay away from single stocks as part of your long-term investment strategy. Now, bonds in a bond market have pretty similar rates of return, around 8% this time, and their risk is a bit lower. Ramsey would call this a medium risk. It has less risk than stocks, but it's still not a slam dunk. Bonds tend to fluctuate, so it's not a guarantee. And the way these bonds work, if you recall, is that you lend money to a business or oftentimes the government if you're buying a government bond. And the way you make money is that this business or government will pay you back with interest. And some people prefer to buy bonds, especially government bonds, because they're patriotic. They're helping our government rather than investing or leaving money with a particular bank. And so that may or may not be a good enough reason for you to invest that way, but oftentimes this is the driving motivation for some. The problem with bonds is that there's a timing component to this. If you've bought a bond with a company and that company goes out of business, or if the government becomes insolvent, then again you've lost your money. That's part of the risk. But also interest rates tend to fluctuate with bonds as well. So the changing interest rates and the potential not to be repaid, especially if a business goes out of business, tends to lead this to not be a great investment either. With our fourth investment option, known as a mutual fund, the risk tends to be pretty low, and the reason for that is because investors pool their money and they put this money, or they manage this money across several companies. This worksheet is saying between 90 and 200 individual companies, but I've seen them as much as more than 1,000, in fact. So the mutual fund can be spread out over hundreds or thousands of companies. The nice thing about this is when you spread your money carefully over representatives across the entire stock market, you should see a pretty good rate of return. Probably I don't know if you want to call it above average, but I'm going to call it a good rate of return, between 10 and 12% on your money. This is what the stock market's been averaging, and a good mutual fund will mimic the stock market. One of the biggest advantages for investing in a mutual fund is diversification. Your money is spread around across many different businesses, many different stocks within the mutual fund, and so it's more or less, I don't want to say protected, but it's safe from radical changes in the market. So long term, this is definitely going to pay off in such good ways. But speaking of that, this is not something that you can just buy into and then 3 or 4 years later get out of, because the money just won't grow that quickly. This is definitely a long-term investment. It takes a long time to see the growth, especially significant advances in growth. This is going to take a long time before you tend to see those results. So in general, I think a mutual fund is a good thing, but if long-term, if you need the money more quickly than, say, 20 or 30 years down the road, then a mutual fund might not be for you. Now, in the rental real estate option, Ramsey says that this is definitely a high-risk investment. Imagine if you're the owner of a house or an apartment complex, or even the owner of a strip mall, a commercial building, and you've got tenants that are in your property. Well, of course it's going to be high risk, because you're trusting other people to live in or work inside of one of your own buildings, and you're trusting them not to tear it up. You're also trusting them to pay their bills on time and pay your rent. I should say pay you rent. So again, the way it works is that you own the property. Also, you have to maintain the property, make sure that it's in good working order, as well as paying property taxes and the like on it. And in return, somebody else is paying you rent. Usually this is a monthly fee that you're charging this person or couple that's living in a house. It may be a yearly lease where a business pays for a year at a time. But again, somebody else is paying you for you to maintain and own the property. In the long term, this is really a pretty good investment. Property values tend to increase over time, and if you hold on to this real estate for a long amount of time, you will most likely see an increase not only in property value, but you'll also be able to receive the income all along the way. The downfall or disadvantage to this type of investment is that you need a lot of cash. Ramsey says you should only buy rental properties with cash. And the idea here is that if you're borrowing money to purchase an investment property, well, you're borrowing money to make an investment. And he doesn't like that idea. But also, if you're borrowing money, you have to make that monthly payment on your mortgage or on the loan that you're using to borrow that money. And if you don't have any tenants in your building for some amount of time, well, you still have to pay the bill, and you're not receiving any income from the tenants that are supposed to occupy your building. Or if a tenant just refuses to pay or can't pay or needs to be evicted, well, those are all costs that you have to incur and simultaneously not have any income at that time. And all the while, if you did not use cash to purchase these properties, then you will have to make payments on your loan. So very, very difficult. So the last investment option is called an annuity. And with annuities, there's very low risk to invest, but at the same time, your return is very low. Most of the time, annuities are fixed. They have a fixed rate, and it's a very low rate of return. They're slightly higher, or have the potential to be a little bit higher, if you have a variable interest rate, something that changes over time. The trouble with a variable interest rate is sometimes the rates go up, sometimes they go down, and in general, I think they do outpace fixed rates, but If you're afraid to participate in a downturn or a low rate of return, then you'll probably want to stay away from this. But essentially, an annuity is a savings account with an insurance company instead of a bank. So on the plus side, these variable annuities, the rates change because they're tied to mutual funds. And mutual funds tend to be pretty safe in and of themselves. The money that you're putting into this account is growing tax deferred, so that's a big plus. But the rates are just far less than mutual funds on their own. So if you're going to put money into an account that's in turn investing in mutual funds, why go through that middleman and lose out on some of that money? You can just invest in the same mutual funds on your own. On the other hand, these fixed annuities, while the rates won't fluctuate, in general, the return on fixed annuities is much less than any other traditional method. So just like you wouldn't necessarily invest in a variable annuity because you can get the rates of return directly from the mutual funds, you probably won't want to invest in a fixed annuity because the rates are so low relative to other investment options. And while they're fixed and guaranteed, you could probably find something else that will significantly outpace that as an option. So if we look at these options on the whole, Ramsey does like these money market accounts. He'll give that a check. He wouldn't mind you using them, but not really as a long-term investment. He likes them if you want to park your money there, especially for an emergency fund, but he would not recommend that you use a money market account for investing. Now, you saw in the video that as far as single stocks go, he does not like them for long-term investing or investing in general. It's just too risky, and the rate of return just isn't there compared to other options. Similarly with bonds, the risk is much less than single stocks, but again, the rate of return just isn't there. Bonds tend to do more poorly when stocks are doing well. So if you are diversified in the stock market with mutual funds, then you should almost always be outpacing the bond market. So diversification in your stock market comes from purchasing mutual funds, and Dave Ramsey definitely recommends this, especially for long-term investing. This is one of the best ways to consistently see growth over time. It does take some time, and often a lot of time, to see a significant rate of return, but as long as you're patient and you're deliberately saving and investing for your future, then the mutual funds are a wonderful option. He's perfectly fine with rental real estate. That's a good way to invest for your future, but only if you use cash. He doesn't like the notion of you borrowing money for any investments, especially real estate. It's too risky. So as long as you're using cash, then that's going to be a real good option for diversifying your portfolio and having a long-term investment. Lastly, with the annuities, essentially because of the low rate of return, he does not recommend using these. Only in some cases would he recommend using an annuity. For example, if you've maxed out as much as you can put into a mutual fund or other retirement accounts that are available to you, maybe you're making so much money that you have no other place to put it, then you might want to invest in an annuity. But for the vast majority of folks that are out there, most normal people, there are just other options that return better, and you'll see a better return on your money other than annuities. So he does want you to avoid them. So I hope this video and worksheet helps you out. I don't think that any of you are going to run right out and start investing right now, but if you keep this handout so that sometime down the road you may start thinking about investing again, you may think about preparing for your future. Hold on to this, dig it out in a couple of years when you think you're ready, and look at the options again and try to jog your memory as to what we've been talking about in this class, and hopefully that'll set you up for future success. Thanks for watching.